So you're an entrepreneur in Canada, dreaming of buying a home. But man, does it feel like a maze, right? Well, good news. It's a solvable maze. And today, we're going to give you the map.
I mean, how many of you have felt this? This quote just hits the nail on the head. It feels like the whole system wasn't built for us, for the way we actually make a living. And you know what? You're not wrong. But here's the thing. It's a common feeling, for sure, but it is absolutely not a dead end.
And that map? That's what we're here for. We're going to take that confusing maze and turn it into a clear, step-by-step path. By the end of this, you'll know exactly how to navigate the whole process with confidence.
Okay, so first things first. Let's get right to the heart of the problem. Why is it so much harder? It's not because you don't make good money. It's because of how you make it. And that simple difference is what creates this standoff with the old-school lending rules.
Okay, so think about it from the lender's point of view. They have one true love: predictability. An employee, a salary applicant, they're easy. They've got a T4, they've got pay stubs. It's a nice, neat, predictable line. But us, the self-employed, our income can go up, it can go down, it's variable. And proving that it's stable takes a lot more than a single piece of paper. You have to tell a whole story.
All right, so if you want to win the game, you got to know the rules, right? So let's do something really important. Let's pull back the curtain and learn to think like a lender, like an underwriter. It's not some big secret mystery. It's really just a checklist. And we're about to go through that checklist, item by item.
So think of your application like a table. It needs 4 solid legs to stand on. First, income stability. They want to see a track record, usually at least 2 years. Second, your credit history. You got to have a decent score. The official guideline from CMHC is a minimum of 600. Third, the down payment. They want to know where it came from and how big it is. And finally, overall affordability. It all has to boil down to one simple question: can you actually handle the debt?
Okay, get ready for some alphabet soup, because you're going to hear these acronyms thrown around a lot. GDS and TDS. That's gross debt service and total debt service. Look, don't let the jargon scare you. All they are, they're just simple calculators the bank uses to figure out how much of your income is already spoken for by your house and all your other debts.
And here's what that math looks like in practice. This is the box you have to fit into. Lenders have these hard limits. Generally, they don't want your housing costs, that's GDS, to be more than 39% of your gross income, and your total debt, your TDS, can't be more than 44%. For insured mortgages, these aren't suggestions. They're pretty much the law of the land.
All right, and now for the big one, the hurdle that trips up so many people, the mortgage stress test. It's not enough to prove you can afford your mortgage payments at today's interest rate. No. The government wants lenders to make sure you could still handle it if rates were to jump up in the future. For them, it's all about managing risk.
And the formula is actually pretty straightforward. You have to qualify for your mortgage at whatever your contract rate is, plus 2%. Or you have to qualify at the government's minimum rate, which is 5.25% right now, whichever one of those is higher. So let's say you get an amazing rate of 4%. The bank actually has to test your finances as if the rate were 6%. You can see how for someone who's self-employed and maybe already showing a lower income on paper, this test can really shrink your borrowing power.
Okay, so we know what the lenders are looking for. Now, the big question is, how do we give it to them? It's time to gather our tools. We need to assemble the documents that are going to prove without a doubt your financial strength.
This right here, this is your document toolkit, your arsenal. You've got your T1 tax forms and your notices of assessment, your NOAs. That's what you've told the CRA. But then you've got your business's financial statements and bank statements. That shows the real story, the cash that's actually flowing through your business. Putting them all together is how you paint that complete, convincing picture for the underwriter.
Now, here's something that's super important to understand. Not all lenders read your story the same way. Most will take your last 2 years of income and just average them out. Simple enough. But a more conservative lender, they might look at those 2 years and only use the lowest income year to qualify you. See? That's a huge difference. So you have to know how your history is going to be interpreted.
But here's a little bit of a silver lining. There are actually 2 different paths you can take. The first is proven income. That's the standard route, using your tax returns. But what if you're a really smart business owner who's amazing at finding deductions to lower your taxes? Well, that's where the stated income path comes into play. This is a game changer. Certain lenders will look past your tax returns and focus on what really matters, the cash flow in your business bank accounts. They'll use that to make a reasonable assumption about your real income. For so many entrepreneurs, this is the key that unlocks the door.
Okay, now we get to my favorite part, the strategy. See, this isn't just about handing over a pile of papers. It's about playing chess, not checkers. It's about making smart, strategic moves in the months or even years before you apply, so you walk in from a position of strength.
And this brings us to the ultimate question for every self-employed person thinking about a mortgage. To deduct or not to deduct? That is the question. It's this crazy conflict, right? The very thing you do to save money on taxes could be the one thing holding you back from buying a home.
And this lays it out perfectly. It is the great trade-off. On one hand, you've got the short-term win. You claim every possible deduction and boom, you pay less tax. Awesome. But on the other hand, you have the long-term goal, getting that mortgage, which means you need to show a higher qualifying income on paper. It's a total balancing act, and it's one you need to start thinking about way ahead of time.
But wait, there is a way to bridge that gap. It's a fantastic strategy called the add back. A lot of lenders get it. They know that some of your business expenses aren't actually cash leaving your pocket. Think about depreciation. You're not writing a check for that. Or the part of your home you use for your business. So what they can do is add back those amounts to your net income. Let's say your net income on your tax return is $80,000, but you had $10,000 in these kinds of non-cash expenses. A smart lender can actually qualify you as if your income was $90,000. This is a huge, huge advantage.
Okay, so let's boil this down to 4 things you can do like right now to make your application stronger. 1, get your story straight. Make it easy for an underwriter to understand your business. 2, for the love of all that is holy, separate your business and personal bank accounts. It makes everything so much cleaner. 3, crush that high-interest debt, like credit cards. That'll improve your TDS ratio. And 4, keep up with the tax man. Stay filed, stay paid. Simple, but so important.
Last but not least, let's talk about who you apply with, because this is just as critical as your paperwork. Not all lenders are created equal. Some, well, they just don't get the self-employed world. Others specialize in it and are way more flexible.
So here's the landscape. You've got your A lenders. Think the big banks. They have the best interest rates, but they have the toughest, most rigid rules. Then you have B lenders. They're more flexible, they're cool with stated income, but you're going to pay a higher rate for that flexibility. And then there are credit unions, which can be this awesome sweet spot in the middle, often with great service. Your best bet? A good mortgage broker. They're like a matchmaker who knows all these players and can find the perfect fit for you.
All right, so let's tie this all up. Is getting a mortgage when you're self-employed a straight shot? Nope, it's not. It definitely takes more prep, more paperwork, more strategy. But as we've just laid out, it is absolutely a path you can navigate. And having this map, well, that makes all the difference.
And that really brings us to the final question, the one that's just for you. Now that you've seen what lenders are looking for, now that you know the strategies, take a second. Is your business set up for your homeownership dream? What's your next move to get those two things in perfect alignment? The path is clear. Now you know how to walk it.